Hey everyone, John Henry here, and today in the market psychology video, we're going to be taking a look at the gold futures. Now, gold, if you can't tell by the chart, had a very large gap up, and a lot of that is primarily due to the fact that, well, a little thing called FOMC came out yesterday. I'm sure you're sick of hearing about the FOMC, but that did cause a relatively decent rally in gold, and we open up this morning with a good gap higher. Now, looking back at yesterday was really nothing more than a range. We started off the day there with a big blast higher and then range, right? We just kind of fell dead in the water. And then coming in today, we find the exact same thing. Big gap up. FOMC is out of the way, which is a good thing. We have a big first candle showing that buyers may want to try to buy into it, but then it stalls out. Now, we do know that this is a bull bias, so we need to be looking to buy and potentially buy low if possible. Remember, we didn't have this information at the time, so we see this big spike up. The sellers try coming in, they fail and turn back around. That is a very nice buy signal. It's just in this case, you ended up having to hold it for a very long time before we finally had the breakout move. And this is what you would call a breakout pause, right? We form that move higher, we break out on the gap higher, followed through continuation from the buyers, and then it goes sideways for a very long time before it finally breaks out again. And this breakout proves that the buyers own it, so the next pullback you want to be a buyer on. But before we get to there, we go sideways for a very long period of time. We form a range at the highs and at the lows. We know that this is an obvious bull bias, so we need to wait for the sellers to get trapped in so that we can buy against them, right? So we have a big breakout move up. The sellers try taking it all back, which is inevitably going to trap sellers in. Big bear bar, looks exhausted, looks at the highs, people not paying attention to the context of the situation. They're going to sell into that like crazy. The problem is that's a really bad place to enter a sell. You're selling at the lows of a range in a bull bias. There's no more room for the trade to work for the sellers, but they will sell there. And we know that their stops are going to be not only above that candle, but above the highs as well. So we're looking to buy into them, looking for the stop run back up to the highs. And that's exactly what happened. That's why you don't go against this strong of a trend. We push back up to the highs. We know that the breakout succeeded. The buyers in this case are showing a huge amount of sentiment. We're looking to buy the next pullback. We get the first pullback. Buyers look really weak here. They don't look like they're interested as of yet. And same with right here. We finally get to test the moving average, the first one of the day, and we're also now coming down into possible rising support. And a beautiful bull candle right back up again. You better believe that is another good buy signal, looking for the market now to go back to the highs, knowing that we broke out higher, and we're still making higher lows. So everything is pointing to the upside, and that's exactly where we just got to, right, during this recording, to the tick at the high. So just a beautiful bounce off the moving average, and just a gorgeous combination of not only the technical analysis side of things, but market psychology. Knowing what to do in this type of environment is invaluable, and this really goes to show you, if you're on the wrong side of today, it can definitely get a little painful. So good examples of both market psychology and technical analysis. Hopefully you learned something. If you didn't, at least hopefully you found it interesting. And until the next one, we'll talk to y'all later.